Everyone who has ever stood at the base of a mountain has had the same thought. Buy the mountain, build some lifts, sell hot chocolate, get rich. In 1996, a man named Les Otten had that exact thought, and the money to act on it. He spent $400 million buying 6 ski resorts in 3 years. By the time he was done, his company owed $416 million to lenders it could not pay back. He didn't lose because he didn't understand skiing. He lost because he didn't understand the business underneath the skiing. Here is what this actually costs. Start with the land. Most American ski resorts don't own their mountain outright. They operate on a special use permit from the U.S. Forest Service, which means before a single lift is built, you're already paying an annual fee tied to your revenue, and you've already spent $1 to $2 million on environmental impact studies, wetland surveys, and water rights filings that can take years to clear. Then the lifts. A basic fixed-grip chairlift starts around $2 million. A high-speed detachable quad, the kind guests actually expect at a real resort, runs anywhere from $4 to $10 million. Big Sky's Ramcharger 8 came in near $4.8 million. Okemo's Telemix cost $8 million back in 2014. Build 4 lifts to open a mid-size mountain and you're already at $14 million before a single guest buys a ticket. Snowmaking infrastructure, the pipes, pumps, compressors, and guns needed to manufacture your product when nature doesn't, adds another $4 million in capital cost. A base lodge with food service, rental, and ski school space, $8 million. A grooming fleet of 6 snowcats at $300,000 to $400,000 each, over $2 million. Parking, utilities, and base area infrastructure, $6 million more. Add the regulatory and compliance costs nobody puts in the pitch deck, permitting, legal, insurance bonding required by your lender before they'll release a dollar, and you're looking at another $1.8 million. Total entry cost for a modest, mid-size regional resort, $38 million. And that's before you've made your first dollar of revenue. Now the bill that arrives every single year, whether it snows or not. Payroll comes first, because a ski resort is one of the most labor-dense businesses in tourism. Lift operators, ski patrol, groomers, food service, ski school instructors. For a mid-size resort running roughly 700 seasonal employees, alongside 60 year-round staff, payroll lands around $8.4 million. Snowmaking operations, the electricity, water, and overnight labor to actually run the guns, cost between $500,000 and $3.5 million a season, depending on how much natural snow shows up. Budget, $1.6 million, as a realistic middle. General electricity for lifts, buildings, and base operations beyond snowmaking, $900,000. Lift maintenance and mandatory annual safety inspection, $600,000. Insurance, general liability, property, and workers' compensation runs $500,000 to $3 million industry-wide. A resort this size lands near $1.4 million. Diesel for the grooming fleet, $350,000. Land use and permit fees, $380,000. Marketing and guest acquisition, $650,000. Food and beverage cost of goods, $1.1 million. Retail and rental equipment turnover, $500,000. General administration, legal, and software, $700,000. Property tax, $350,000. Added up, and the full annual operating cost before a single lift ticket is sold comes to roughly $17 million. So how does the mountain make its money back? The national average weekend lift ticket price is now $198, according to the Kottke end-of-season guest experience study. But almost half of all skier visits nationally come from season pass holders buying at a steep discount, and only about a third are full-price day tickets. Blend that against food, beverage, rental, and ski school spending, and a realistic revenue per visit figure for a resort like ours is closer to $88. Multiply that by 250,000 skier visits in a decent season, a reasonable number for a mid-size regional mountain, and gross revenue lands at $22 million. Subtract the $17 million operating cost stack from Section 2, and operating income before debt is $5 million. That already sounds thin for a business that took $38 million to build. It gets thinner. The National Ski Areas Association reports that the average resort reinvests around $21 to $29 per skier visit back into infrastructure just to stay competitive. New lifts, new snow guns, replaced grooming equipment. At 250,000 visits, that's a mandatory $6.25 million reinvestment bill. Subtract that, and the $5 million operating income turns into a net shortfall of over $1 million before you've paid a cent of interest on the debt that built the place. The margin isn't thin. In a normal year, it's negative. That's before anything goes wrong. There's a variable sitting underneath every ski resort's balance sheet that has nothing to do with snow, and it has ended more resorts than bad weather ever has. That variable is credit. Ski resorts are financed like real estate. Long amortization schedules, large loan balances, and lenders who can call in that debt the moment their own balance sheet gets shaky. In November 2009, Montana's Moonlight Basin filed for Chapter 11 bankruptcy protection, specifically because its lender, Lehman Brothers, was moving to foreclose on the resort in the aftermath of Lehman's own 2008 collapse. Moonlight hadn't done anything wrong that season. Its lender had simply stopped existing. This is the trap. A ski resort's operating cash flow moves on a 5-month winter clock, but its debt obligations move on the same 12-month calendar as every other business in America. When credit tightens, during a financial crisis, a rate hiking cycle, or a regional banking shock, the resort's revenue hasn't changed, but the cost of servicing its debt, or its lender's ability to keep extending it, has changed dramatically. A business built on snowfall is also, quietly, a leveraged real estate bet. One company took that leveraged bet further than almost anyone in ski history. It didn't just survive the trap. For a decade, it seemed to have beaten it. Then it didn't. American Skiing Company began as a single mountain, Sunday River, Maine, built successfully by founder Les Otten starting in 1980. By the mid-1990s, Otten decided to scale fast. Between 1996 and 1998, ASC quadrupled in size, spending roughly $400 million to acquire 6 additional resorts, including Heavenly in California and Steamboat in Colorado. Revenue exploded from $175 million in fiscal 1997 to $340 million in fiscal 1998. On paper, this looked like a triumph. But the acquisitions were funded with debt, and ASC layered a second bet on top, a real estate financing model built around quarter-share condo hotels at each resort, where investor income was supposed to help carry the company's balance sheet. The company went public on the New York Stock Exchange in 1997. By fiscal 1998, despite record revenue, ASC posted a $6.95 million operating loss and carried $416 million in debt. The unwind took years, not months. Heavenly was sold to Vail Resorts in 2002. Steamboat went to IntraWest in 2007. Killington and Pico were eventually sold off to Powder. Piece by piece, the company that had briefly been the largest ski operator in New England ceased to exist as an independent entity. This was not a story about bad snow, bad marketing, or bad mountain management. Every one of those resorts kept operating, kept selling lift tickets, kept guests happy. It was a story about a company that financed growth with debt faster than its cash flow. A 5-month-a-year cash flow could ever service it. That is not a management failure. That is the structure of this industry, doing exactly what it does to over-leveraged operators. Here's a cost that never appears on a resort's projected income statement: the single liability claim that erases an entire season. Picture a resort having a genuinely strong year: 260,000 visits, $23 million in revenue, costs under control. Then, in February, a guest is seriously injured on a poorly marked trail intersection. The claim moves through the resort's insurance, but even with coverage, the deductible, the legal defense costs, and the immediate spike in next season's liability premium routinely total $400,000 to $800,000. On a business already operating with a 5 to 10% margin in a good year, that single transaction, which looked like nothing more than a line on an incident report in February, converts a modestly profitable season into a loss. It never shows up in the marketing deck's average season projection, because averages don't include the year something goes wrong. Every resort has one of those years eventually. There is another cost growing faster than any other line item in this industry, and unlike a lawsuit, it doesn't happen once. It compounds every single year. That cost is snowmaking, and it is rising because the climate a resort depends on is becoming less reliable, not more. A 2024 study found snowmaking expenses now range from $1,257 per acre in the Pacific Northwest to $2,673 per acre in the Northeast. And that gap is widening as warm spells push more of the season onto artificial snow. In late 2025, a cluster of resorts, Whitecap Mountains, Mountain Creek, Yellowstone, Tamarack, and Pecan Peak, all filed for bankruptcy within the same stretch, each citing the same combination: heavy debt loads, high operating costs, and weather variability that no longer behaves the way it did 20 years ago. The systemic risk isn't one bad storm. It's a warm December that pushes your snowmaking budget up 40% in a single month, while simultaneously cutting your early season visits, the exact combination that drains cash reserves and revenue at the same time. This is not a slow, manageable cost creep. This is the kind of single-season event that can end a leveraged operator in one winter. Here's where it gets counterintuitive. Some of this gets dramatically easier at scale: fixed costs, insurance, snowmaking capital, marketing, permitting, compliance, spread across more skier visits. So cost per visit drops as size increases. And the season pass model, where roughly half of all national skier visits now come from pass holders who paid months before the first snowflake fell, lets large operators lock in a chunk of revenue regardless of what winter actually delivers. But other things get harder at scale. More terrain across more mountains means more microclimates and more independent snowmaking exposure. Larger debt loads mean larger, less flexible obligations. More employees and more locations mean more regulatory surface area and more chances for the hidden costs in Sections 6 and 7 to hit simultaneously rather than one at a time. At a certain size, this stops being a ski operations business and becomes something else entirely: a financial engineering business built on multi-resort season pass revenue, real estate development, and debt structured across dozens of properties instead of one. That's a genuinely different business than the $38 million single mountain we started with. And most operators never make it far enough to find out which side of that line they're on. Let's run the actual numbers. 2 ways. Optimistic scenario. Assume a strong snow year. 280,000 visits. Revenue per visit holds at $88 for total revenue of $24.6 million. Operating costs stay controlled at $16.5 million. Debt service on the resort's financing runs $2.3 million a year. Reinvestment is only partially funded, at $5 million, because the resort chooses to defer some upgrades. Net result, roughly $800,000 in profit on a $38 million asset That's a return of about 2% in the good year. Realistic scenario, same starting point. Then, one bad contract, a snowmaking equipment failure requiring an emergency $600,000 mid-season repair. One lawsuit, a liability claim costing $450,000 after the insurance deductible. One equipment failure, a chairlift gearbox replacement at $350,000. Unplanned and non-negotiable, because a lift can't run unsafe. That's $1.4 million in unplanned costs added to the base case. The $800,000 optimistic profit becomes a $600,000 net loss. The difference between those two scenarios is one equipment failure, one lawsuit, and one bad vendor contract. None of these are exotic disasters. All three happen to someone in this industry every single week. Since 1982, roughly 224 small ski areas in the U.S. have closed because they couldn't compete. Nearly 60% of all ski resorts built across North America during the 1960s and 70s construction boom have shut down entirely. The primary cause, across decades of closures, is almost never described by industry analysts as bad skiing or poor mountain management. It's financial and structural. Over-leverage, single revenue dependence, and deferred capital investment that compounds until the resort can no longer compete. The resorts that survive share a specific, unglamorous set of habits. They build a large season pass base before winter starts, converting weather-dependent revenue into pre-sold, guaranteed cash flow. They maintain a genuine multi-year capital reserve fund instead of financing every single lift replacement with fresh debt. They diversify revenue beyond snow sports entirely: summer mountain biking, weddings, real estate. So 5 winter months don't have to carry 12 months of fixed costs. They treat snowmaking redundancy as a planned capital investment made early, not an emergency expense made in a panic during a warm December. And they keep debt-to-cash flow ratios conservative, deliberately avoiding the acquisition-fueled leverage strategy that took down American Skiing Company. None of these are exciting. None of them make a good tagline. All 5 are the actual difference between the resorts still open today and the roughly 130 that have closed since the 1980s alone. So go back to the dream we opened with. Buy the mountain, build the lifts, sell the hot chocolate. The real version of that dream costs $38 million to open, $17 million a year just to keep running. And in a normal season, after the reinvestment the industry itself says is mandatory, the math is already negative before a single lawsuit, equipment failure, or warm December shows up. Owning a ski resort was never a business exposed to weather. It's a business that has to survive weather, debt, and a capital bill that never stops arriving, all at once, every single year. If you want more forensic breakdowns like this one, subscribe. There's a new one coming.